Hello, welcome to Sponda. My name is Gustavo Sayani. I am the creator of Sponda. Please visit, by the way, sponda.capital. It's a free tool. And this is our fourth video in a series about the fundamentals, the basics of investing. We will continue talking about risk, about leverage, about debt. We dedicated our last video to the comparison between debt and a company's equity. And today we're going to talk about the relationship between a company's debt and its earnings. So we introduce a concept called earnings, which can also be called profits or net income, which is, in terms of accounting, how much money a company makes over a given amount of time. A quarter, a year, so on and so forth. So this relationship is maybe simplistic, but it's super useful in many cases. So consider the company is posting, let's say, $1 million a year in profits. And that's fairly stable. And you have reason to believe that it will continue to be the case for the foreseeable future. So 1 million profit, great. Now this company has $100,000 in debt. So it would be able to pay back its debt in a matter of a month and a half or thereabouts, if it's so desired. So it's pretty light. Its debt load, it's pretty light. Now compare that with a company that also makes $1 million per year on average, but carries a debt of $10 million. So the equivalent of 10 years worth of those earnings. Let's try to remember that debt carries interest. So the company will need to pay back eventually what it owes, and meanwhile it will need to keep paying interest. So this is a heavy load to carry, right? And this is the reason why just taking a look at this indicator can often just tell you to move on and take a look at the next company. The one person that I remember who just gave a guidepost, like a hard number here, would be Peter Lynch. And he talks about 3, the ratio being 3. So anything beyond 3, he is loath to continue analyzing. Any company whose debt is less than 3 times its average earnings, then he's interested in looking further. So I use that, that's something that I consider. Of course, as with any indicator, ideally you have to confront this with other indicators in that company, indicators, the same indicators for companies in that same sector, in the market as a whole, other sorts of securities. Also, if these earnings have been growing or decreasing, also if this debt has been growing or decreasing. So it gets very beautiful. But to begin, just considering this ratio is extremely helpful versus people who invest or buy stock without even looking. So that's it for debt to earnings for now. And you can find this indicator right here. So under leverage, gross debt dot earnings. And yeah, till next one, I'll continue talking a little bit more about leverage. Bye-bye.